I'm unpacking a massive shift in Canada's real estate landscape. I'm talking about the new capital gains tax increase. Whether you're an investor, a homeowner, or eyeing your first property, understanding this change is crucial. Hit that like button if you're ready to dive into these complex waters, and subscribe to stay ahead of the real estate game. Let's start with the basics. The Canadian government has revised the capital gains tax effective June 25th, 2024. For individuals, gains over $250,000 now face a 66% inclusion rate. For corporations, there is a flat 66% on all gains. Big numbers, right? But what does this actually mean for the market and for you personally? Consider this. You're an investor thinking about selling a property you bought 5 years ago, which has appreciated significantly. Now, previously, the tax hit might have been manageable, but now the new tax could take a serious bite out of your profit. So what do? Well, let's crunch the numbers. Let's say you stand to make $300,000 gain on a sale. Under the old rules, you'd pay taxes on $150,000 of that gain. With the new rules, you're taxed on $198,000 of it. That's nearly $50,000 more of your gain being taxed, and at your highest marginal tax rate. This can add up to thousands in extra taxes.
Investors are definitely thinking twice about selling right now. This could lead to a drop in available properties, tightening supply further, and potentially driving prices up again. It is a double-edged sword though. On the one hand, it increases government revenue. On the other hand, it could stall the turnover rate in the housing market altogether.
Now let's broaden our lens. What does this mean for the overall market? Fewer homes for sale mean less choice for buyers, potentially higher prices, and a tougher market for first-time buyers. But there's more. This tax is not just about individual homeowners. Think about larger investors and corporations. These players often hold multiple properties and are crucial for rental markets. The higher tax burden could discourage them from selling, impacting rental availability and pricing. And remember, this isn't just about residential real estate. Commercial properties, large-scale developments, they're all affected. Different regions could see these changes differently. For instance, areas with high property appreciation rates like Toronto and Vancouver could see significant shifts in investor behavior. Let's take a closer look at how these cities could navigate the new tax landscape.
Now, in high growth areas, we could see some cooling as investors hold on to properties longer to avoid these hefty taxes. This might slow some of the speculative buy-in that we've been seeing in recent years.
And let's not forget, the government has ambitious housing targets to meet. They're aiming to stimulate construction and improve affordability. Their plan lays out a bold strategy to build 3.87 million new homes by 2031. That works out to 522,000 homes per year starting now until 2031. The most homes Canada ever built in a single year was back in 1974. With 257,000 homes. In recent years, the peak was 222,000 homes in 2021, and that number declined in 2022. We don't have 2023 numbers yet, but suddenly we're supposed to double that number when it's never been done before. Interestingly, the government expects this measure will increase federal revenues by $19.4 billion over 5 years, beginning in 2024-25. The exact sum needed to fund the construction of those 3.87 million new homes by 2031. But here's the kicker. If private developers and investors pull back because of the capital gains tax, meeting these targets will become even more challenging. Is the government banking on many people panic selling before the June 25th deadline? Remember, the government doesn't get any additional revenue if corporations and investors don't sell. This leads us to question whether the tax policy was designed in part to trigger a surge in short-term property sales. But what happens after the surge? Will the market stagnate? And will construction goals remain just lofty ambitions? These are big questions that demand careful consideration. The interplay between tax policy and housing strategy isn't just about numbers. It's about real impacts on real people's lives and the future landscape of our communities. What's your take? Let's keep the conversation going. Will this change your investment strategy or home buying plans? What do you think of these developments? Are they a necessary correction or a potential misstep? Drop a comment below. I'd love to hear your thoughts. Your insight is invaluable as we navigate these changing tides together. Hey, thanks very much for watching. If you enjoyed that video and you want to learn more about Metro Vancouver neighborhoods, check them out on this playlist right here. And while you're here, hit that subscribe button, because on this channel, you're going to find everything you need to live, love, and own here in Vancouver. So don't forget to subscribe.